Hi, and welcome to Macro Matters. My name's Stephanie Kelly, and together with my co-host Paul Diggle, we'll be guiding you through the complex world of politics, economics, and markets. And we finally made it to 2021 after all the challenges that 2020 faced, both personally, professionally, but also in markets. Quite a challenging year. And I think there are very high hopes for what 2021 might bring. So today, Paul and I are going to be chatting about what we think the biggest questions are for the global economy and markets in 2021, where the opportunities are, but also where we continue to see challenges. So, Paul, great to have you on. We're very rarely on at the same time.
Yeah, good to see you. Happy New Year, Steph.
Happy New Year. So maybe let's kick off. I won't lie, slightly downbeat question, which is around the renewed lockdown. So one of the things we've seen, particularly in the wake of Christmas and all the mixing that people did over that period, but even before then, we saw this kind of ratcheting up of COVID cases and renewed lockdowns, in particular, kind of from the 26th of December onwards in the UK and Europe. So how big is that drag from these renewed lockdowns going to be?
I think the short answer is it's very large, and in a number of important economies, it's going to send them into double dip recessions. That's certainly the case for the Eurozone and the UK, which is where the call it a second or a third wave. Certainly, the new variant of the virus is most concentrated. And I actually think those economies, both Q4 of last year and Q1 of this year, negative quarters, and that meets this canonical definition of a double dip recession. And one thing we know about double dip recessions is that they're associated with more long-term damage from a recession as well, if you go back into it a second time. So that's certainly a problem for those economies. It strikes me the US is a much more complicated case because it's certainly having a very big second or third wave, and there has been some increase in lockdown stringency. But at the same time, it's just received a big dose of fiscal stimulus. There's perhaps more on the way, and there is less lockdown stringency per unit of coronavirus, it seems, or there's less sort of cultural, political willingness to lock down. So I probably don't think that means double dip recession in the US, but definitely a slowing over the winter. But the other thing to say about the size of the impact of the renewed lockdowns is it's probably smaller than it was back in spring of 2020. Remember, in H1 of last year, the global economy contracted 10%. That was huge. And the peak to trough fall in many economies was perhaps double that. And that's not what I would expect to see this time around, because to some extent, we've all adapted to living under lockdown conditions. More can operate economically, certainly in the manufacturing sector, and adherence to the lockdown, it seems, is a bit lower this time around. And then maybe the final thing to say is that there'll probably be big differences between countries. Now, I've mentioned Europe versus the US as an important difference in terms of how big the renewed contraction is. Within Europe, there'll be important differences in the core versus the periphery of Europe, because they have different size manufacturing sectors which are still operating during this lockdown. And in East Asia versus the North Atlantic countries, where in the former there are smaller second waves, there's still some that are smaller. So I think there's a lot of regional heterogeneity around the world. But the short answer is it's bad that this has happened, that we're in renewed lockdowns, and it must exert some economic drag. But I mean, Steph, one of the key questions related to that, of course, is vaccine rollout and how quickly vaccines can be rolled out and can to get us out of this situation. So what are we seeing in terms of the early evidence of the speed of vaccine rollout?
So again, I think you mentioned heterogeneity a minute ago when it comes to lockdowns. We're also seeing a lot of heterogeneity when it comes to vaccine rollout. Now, we kind of expected this. This is one of the reasons why we do our kind of vaccine forecasting at a kind of a country or at least regional level. The reason being that, different countries have different geographies, they have different population sizes, they have different rural-urban divides. population density can have a big impact on how easy or difficult it is to roll out. And we're seeing that really in practice today. So if you look across the world, Israel has been making headlines for having, the latest numbers I saw at the start of the week was having inoculated 20% of their population. I think that's with the first dose. So not full inoculation, but they've vaccinated for the first dose, 20% of their population. Compare that to the US and the UK, who are seen as kind of front runners in a way, and they're at about 2%. I think the US is a little ahead of the UK. But in some ways, maybe we shouldn't be too surprised that there have been some delays and some, capacity constraints. And that's both in terms of, again, this reinforces why we do the vaccine forecast the way we do. It's manufacturing capacity constraints and it's rollout constraints. It's challenges with rolling out. Do you choose to use big vaccination centers, or do you choose to use localized GP surgeries and pharmacies? In some countries, one choice will be right. In another country, another choice will be right, because culture is different, populations are different. So all of that is to say that it's been a mixed bag so far. Arguably slower in European countries in particular than many had hoped, but they are operating with quite large potential supplies of very high efficacy vaccines. So they have a lot of the Pfizer and Moderna vaccines, which should be positive. So I kind of think we're 12 days into 2021. It's probably too early to really say whether vaccine rollout is going well or not, because most countries only started in the last couple of weeks. So I would say maybe hold fire for now. But I think the issues with capacity, more so in terms of rollout, will be the ones that ultimately drive takeoff. Not only, we can, of course, there's always the issue with, will people take the vaccine? And we know France is a good example of a country where willingness to take the vaccine is very low, and that's certainly a concern there. But in other places, it's less of a concern. The UK, even in the US, willingness to take the vaccine has risen in recent months. So I guess the bigger question is, if we think that they can continue to roll it out gradually in very heterogeneous ways, what does that mean in terms of macroeconomic traction? I know, Paul, you're in the middle of updating our forecast, this kind of interim forecast update. How do you think about how the vaccines might kind of ultimately get a foothold in macroeconomic activity and start to see much more, I guess, increased willingness to go outside and interact with the economy and ultimately drive greater growth?
Sure, yeah, and I should remind our listeners, actually, that episode 7 was the one in which we talked about our vaccine baseline and how we'd incorporated vaccine expectations. So go back and have a listen and sort of see what we got right, what we got wrong in terms of our vaccine expectations. But this is the crucial issue. When does lockdown easing happen in the course of vaccine rollout? Is it once you've vaccinated the most vulnerable 20% of your population, or do you have to wait until you've achieved full herd immunity, 60, 70% of the population inoculated, before you can get a meaningful easing in lockdown and therefore a rebound in the economy? I think that picture will look different in different countries. I think there'll be different political and cultural willingness to reopen with only partial vaccine coverage. So maybe the UK is a country that will look to reopen earlier in that process. By contrast, perhaps Germany or Japan are countries that will look to reopen later in that process and will require much larger levels of coverage. But you mentioned, Steph, that we're going through a sort of forecast update at the moment, and essentially we have Q1 of this year as the trough in economic activity, and then from Q2 a gradual easing in restrictions, which allows some rebound in economic activity. But it's a very phased process. I think the most economically disruptive measures are probably those that get eased first, and they're things like schools, universities reopening, perhaps then some shops reopen, and then there are some measures that we could be living with for all of 2021 and perhaps for much, much longer. I mean, think about additional checks at airports or the requirement to have immunity passports. I think those become part and parcel of everyday life. Even mask wearing could become, in sort of Western economies, a complete norm. A lockdown measure of sorts, which is with us forevermore. So I think it's sort of this partial reopening, which is at different paces in different economies. And perhaps, of course, the sort of unthinkable prospect that we now have to start grappling with is perhaps vaccine rollout will hit this big hurdle of vaccine escape from the virus itself. And there's obviously this potential for mutations to mean that vaccine rollout is set back significantly because it no longer works against new mutations. And that's, of course, another part of the picture that we've had to start taking account of.
Well, I think if anything, that just underscores how important it is to roll the vaccines out quite efficiently, right? Because the longer that we don't have a vaccine and the longer that it's circulating the economy relatively unencumbered, particularly maybe in countries that have had looser restrictions, the more space it has, right, to mutate.
Yeah, absolutely. So I've noticed that there's been some political commentary to the effect that this variant could never have been predicted, but of course allowing high circulation increases the chance, as you say, of any variant actually occurring. So maybe let's move away from sort of coronavirus and vaccine questions to the extent we can, and on to some of the key political themes and questions that are dominating the year ahead. And one of those is, of course, the Brexit deal, Steph, which is now sewn up, or so it seems. I mean, what does that deal actually mean? What did it involve, and how does it change the outlook for 2021?
Sure. I mean, I think in some ways, with all that's gone on with COVID, this Brexit deal, which, you know, a year ago would have been the biggest piece of news that markets, you know, at least UK focused markets would have been dealing with, was a little bit more of like not with a bang, but a whimper, in the sense that a deal got done just before Christmas. Really good Christmas present. But what does it look like? What does it mean? When we've talked about Brexit on this podcast before, we kind of said that our expectation is that you do get to a deal, but that deal is quite limited. And in particular, it's much, much less expansive than what the UK had been enjoying as a member of the European Union, both in terms of access for goods, but particularly for services. So when we look at the actual deal itself, it looks very similar to what we've kind of talked about in the past. So no tariffs or quotas on goods, very limited services sector coverage. Financial services is being negotiated separately, and we're due to get a kind of a memorandum of understanding published in March, is the hope. That will, I think, is with a view to getting this idea of equivalence, which is a UK kind of gift that it can give, but it can also take away at any point for financial services access for third-party countries, which the UK now is. So overall, in some ways, the Brexit deal is as we thought and as we feared. Now, there are nuances in there in terms of some specific sectors have done a little better, some have done a little worse, and we're going to do a lot more work into that in the coming weeks. But I suppose the headline remains the same, which is this is a Brexit deal that is better than not getting any deal at all, but is by no means a net positive to the UK's position with its major trading partners. And we think that should have an impact not only on kind of medium to long-term growth in the UK, but also on how companies operate and the decisions that they make about investing, because your ability to invest in this environment is quite limited, in particular because one of the big issues with the deal is that there is a 5-year review mechanism, and there are actually review mechanisms in certain elements of the deal as well, which means that this idea that Brexit has gone away now is absolutely not the case. We will be dealing with the ramifications and repercussions of Brexit for years to come. And think about it, every 5 years, you could have a completely different political environment in which the Brexit deal is being reviewed. You could have a different government or a different leader, different kind of political preferences of the electorate. So it really does create a lot of uncertainty when we look to the longer term. And I think investors will be grappling with that for years to come.
So what you're telling us, Steph, is Brexit is not done.
It is never done. Brexit is never done.
Well, that's something to look forward to in 5 years' time when the reviews come up. Of course, the other huge political story of the end of last year and the start of this year is in the US. And since our last episode on US politics, we've of course had the outcome of the Georgia Senate runoff elections and a special election, which means that you now have a wafer-thin Democratic control of Congress to go along with the House and the presidency. That has quite big implications for the year ahead, right? Both in terms of the political outlook and the fiscal and economic outlook.
Yeah, absolutely. I mean, we'll go into more detail on the kind of outlook for Biden's administration in a couple of weeks' time on this podcast. But in the meantime, I think what we can clearly say is now that the Democrats have just eked out a majority, and it is an incredibly slim one, the path for fiscal policy in the United States looks very different. In particular, I think we can feel pretty confident about short-term COVID relief coming through. So we're penciling in about $1 trillion worth of COVID relief in Q1, which is really, considering we just got 900 billion, before Christmas, I think that's really quite striking. On top of the 1 trillion in COVID relief, which we expect to be in the form of things like unemployment insurance, stimulus checks being boosted from they're now currently $600. So the expectation is Democrats will boost them to about $2,000. All of those things, they're quite expensive to do, but we expect they'll be able to get them done. The bigger question mark comes in kind of what I might call traditional fiscal policy out with the COVID relief, which is things like healthcare reform, education spending, infrastructure spending. Joe Biden ran on a very, very expansionary fiscal agenda. In particular, it was an agenda that focused on increasing spending to the tune of $5 to $6 trillion, which is partially offset then by tax increases, in particular on corporates and on high-income families. Now, with such a narrow majority, that kind of agenda looks really unrealistic. And the debate that we're having internally is just how much net fiscal stimulus, so that's fiscal stimulus that isn't offset by tax increases, can you actually get in the United States? And that's really tricky. We're so early in the administration. They're not even sitting at the time that we are recording this. The new president hasn't been sworn in. We don't have the new Congress in place. So these are all things I think that we'll just have to wait and see how the politics of the Democratic Party progresses, and in particular, how more moderate politicians like Joe Manchin, who we're going to hear a lot about, he's a senator from West Virginia, who's very moderate and very concerned about fiscal deficits. He might be a really significant constraining factor on what the Democrats can do. But we think net they can probably do some more fiscal stimulus, and that's on top of the $1 trillion in COVID relief we've got. So it's a much, much more expansionary fiscal environment. Which is positive, we think, for the growth environment in the United States. Just how positive that is, I think, is really going to depend on party politics.
Yeah, and so much depends on the swing senators, doesn't it? Joe Manchin on the Democratic side, perhaps Mitt Romney on the Republican side. They are going to be sort of the median voter in the Senate, or the swing voter in the Senate is these. And there's going to be so much politics around these individuals because they're the ones that will have to be brought on side for what is presumably going to be a more moderate agenda than Joe Biden might have liked, or some members of his party might have liked, with a much larger Senate majority.
Yeah, absolutely. Honestly, even a couple more senators would have made a big difference. Even if it was 52-48 instead of the 50-50, it would have made life just that little bit easier for Biden in terms of passing big portions of his policy agenda. I think the question that remains to be seen is to what extent senators like Joe Manchin or Kristen Sinema or even King or Hickenlooper, these more moderate Democrats, to what extent do they stick with their preferences, which has tended to be to not expand the deficit? To what extent does that rule their policymaking over traditional kind of political transactions, which is, if you support this infrastructure bill, then we'll make sure that the new green energy plant is located in West Virginia for Joe Manchin. And I think that's also an element of this. So investors tend to look at fiscal policy from a very top-down perspective. How big is that number? What does that mean for growth? But actually, a lot of the political decisions about how big that number is can come from those kind of ground level decisions about who gets what project in their state and how does that play into their voter base and all that. So it's very much, I think, to be determined. But I think the US in some ways is an unusual case, because you do have a place where, we had been expecting before the Georgia result that there would be a split Congress, a very constrained fiscal environment, and that would really create issues for the US recovery. At the very least, we're not incorporating that, because we think at the very least we'll get somewhere to the tune of $1 trillion of COVID relief, and then hopefully some more in terms of something, we're debating whether that might be 500 billion to $1 trillion in net fiscal stimulus at the end of this year. Or whether it'll end up being smaller. I think that's something that we just need to wait and see how it progresses. But Paul, when you look at kind of outside the US, to what extent are you worried about fiscal cliffs, or, the importance that fiscal policy had in 2020? Do you think it'll have the same role in 2021?
Yeah, so fiscal policy was obviously absolutely central to the crisis fighting effort last year. And in terms of the outlook, I think in the Eurozone, in the UK, maybe in China as well, it's analogous to the US in some ways, because the outlook isn't as bad as it could have been.
Right.
But it's not like fiscal policy is going to be an enormous driver of the recovery and as active as it was in 2020. So to take Europe, for example, the Stability and Growth Pact is still de facto suspended. A lot of countries will run very, very large structural deficits in 2021, and alongside a very active central bank, the market is probably going to be willing to fund, huge fiscal deficits in the likes of Italy. Likewise, the UK and the Conservative government has shown itself willing to respond to renewed lockdowns and a downturn in the economy with fiscal expansion, extensions of furlough and the other fiscal support schemes. Nonetheless, it's not like there's room to expand fiscal policy even further, such that you get a further large fiscal impulse in 2021. Right. So at least those countries aren't repeating the mistakes of the post-financial crisis period, which was a big and premature fiscal tightening, which in Europe's case is what essentially laid the groundwork for the European sovereign debt crisis to come after the financial crisis. Maybe 2022 is a bit more worrying, because by that point you could have the more fiscally conservative European countries saying, right now is the time to sort of start reining in our fiscal spending. The crisis will most likely be passed by that point. And you could get worries about a sharp fiscal contraction then, but it's not a 2021 issue, I don't think. And China is, that's a story of continued background fiscal support. It's certainly not being withdrawn rapidly, but policymakers' marginal preference is to start tackling financial imbalances and financial stability issues, which, as in the episode where, I think it was episode 11, where we talked about China last year, there is this background threat of sort of large imbalances in the Chinese economy, which there'll be some desire to sort of tackle. And that's, again, in contrast to the post-financial crisis period, where China really primed the pump of the global recovery coming out of the financial crisis by unleashing an enormous credit splurge. And that's not what's happening this time around. It's a more measured attempt at fiscal policy and managing financial imbalances.
So against that kind of backdrop, Paul, given the fiscal policy environment, what role then for monetary policy in 2021? Do you see central banks taking this kind of, key steering role? And then, are there any central banks you're worried about acting too quickly or not acting quickly enough?
Yeah, that's important as well, because monetary and fiscal policy have really acted in concert over 2020 to fight the crisis and backstop financial markets in many ways. And I think there's good and bad news in terms of the monetary policy outlook. The good news is that there is little sign of a repeat of the post-financial crisis mistake of a premature monetary policy tightening, which again was a European error leading to the sovereign debt crisis. back in the post-financial crisis period. Central bankers have largely learned the lessons of that period. They want to keep monetary policy very accommodative for a long time. The policy reviews that a number of central banks have gone through. You remember our very first episode was on the Federal Reserve's new mandate and its average inflation target, which was going to embed a more dovish policy path. That means that there's going to be little desire to tighten monetary policy, to raise interest rates, certainly not this year and probably for a number of years. And monetary policy has been generally successful in preventing what's been a sort of a public health crisis and an enforced period of economic activity escalating or morphing into a financial crisis. I mean, there really hasn't been a financial crisis this time around, even though there has been an enormous economic crisis. But the bad news is that we would probably say, and on that episode 1, we did say they could have done better. They could be doing more. The policy reviews could be bolder and commit central banks to even more forcefully to adding additional stimulus and raising inflation. The Fed's forward guidance was sufficiently vague that it's allowed market speculation about when the asset purchase program will be tapered to begin and run fairly rampant actually in the first few weeks of 2021, and hence there has been some sell-off in US bond yields, which is sort of tightening in monetary conditions, and at the margin I think a little bit unhelpful, at least from the central bank's point of view. So and the final bit of bad news is just there's not that much room to add additional stimulus if it becomes necessary. Interest rates are absolutely at the floor, and QE is currently quite large. So it's not like an immediate tightening is on the cards, and that is certainly a supportive backdrop for financial markets. But our report card on central banks would probably be could do better, could make these policy reviews even more thoroughgoing and bolder in terms of what they'd mean for the monetary policy outlook.
And then I think we can't talk monetary policy and we can't talk central banks. We can't talk 2021 without talking about inflation, because that is clearly the topic that is on everyone's lips. So I'm interested to know, which way do you think inflation will go? Yeah,
this has been, as you say, Steph, a huge debate in financial markets. We're getting questions on it constantly. The near-term impact of the coronavirus crisis has, of course, been disinflationary. You see that in the inflation numbers, which are now negative in a number of economies. I mean, they turn negative in China as well as in the Eurozone. The argument that many are making, and again, to go back to our sort of our episodes last season, episode 13, we had a whole discussion about the inflation impacts of the crisis. But the argument many are making is that the amount of stimulus in the system, the fact that monetary policy may become subservient to fiscal aims, the amount of debt that governments have built up necessitates a very loose monetary policy, which could in turn allow inflation to take off. The potential deglobalization effects of the crisis are going to be are a supply shock, which could push inflation higher. So there are plenty of people in the market making this argument that inflation is going to rise. And indeed, over the middle of next year, you're going to get a mechanical increase in inflation because of energy base effects as well. So it's going to look like inflation is really increasing for a period of time. And all this matters greatly because many of the secular moves in financial markets over the past decade, the long rally in bond yields, the outperformance of growth versus value, the sort of equity melt-up more generally, these have all been driven by, in part, a low inflation, low interest rate environment. So that's why this is such an important debate for financial market participants. But we really come down on the other side of the debate, which is that although some of those inflation risks have increased, it's probably the case that the disinflationary forces win out in the end, that the impact of the crisis is to embed low inflation expectations is a big demand shock, further limits the room of central banks to cut interest rates and stimulate an increase in inflation. So I think in the end, we'll learn that we'll look back on the crisis and say it was a disinflationary shock, even if over the next few months in this summer, we're going to go through a period of energy base effects, which are going to make it look like inflation's actually rising quite a lot. So that's about all we've got time for this week. Thank you very much for listening to Macro Matters. We actually now have a mailbox, macromatters@aberdeenstandard.com. And we'd love to hear from you if you have questions for us, topics you'd like to see covered, feedback for myself and Steph. Please do drop us an email, macromatters@aberdeenstandard.com. Don't forget to like or subscribe on your preferred podcast platform. Next week, we are back talking about the post-pandemic future of cities. How do high-density urban agglomerations change after coronavirus? I think that's going to be a really interesting episode. So join us then. But until then, goodbye and good luck out there.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.